having said there's this big extra boost that silver is getting right now because it is a key input into AI data centers, EVs, solar, robots. Because when you have high value electronics, you want to use the absolute best conductor, which happens to be silver. You need silver for these things. They're so high dollar. Like a single chip from NVIDIA, I think is like $14,000 or something. You're not going to skimp using cheap metals. So there's tremendous demand for silver right now. I think that's really what's driven it. But you've seen backwardation over the past couple of months in both gold and silver. And that's something that used to happen like once a generation. And this has happened multiple times, and it's happened with gold as well. So it's not just the AI trade pumping silver. I think what happened there is the debasement trade with that natural experiment where when Doge failed, when unified Republican control failed, a lot of bond investors concluded that there is no hope at this point. The train is going off the cliff.
Welcome back to the Gold Exchange Podcast. I'm joined by Peter St. Onge, fellow at the Mises Institute, former MBA professor, and in my opinion, one of the clearest voices when it comes to fiscal and monetary policy. And if you're not following him on X, I don't know who you're following. Peter, welcome back to the show.
Thanks for having me back, Ben.
All right, Peter, I want to start off talking about trade and tariff policy. Obviously, a big T word in President Trump's vocabulary has been trade and tariffs, most specifically. Where do we stand on tariff policy? Obviously, the Supreme Court struck down these tariffs. President Trump said, I'm going to try another way. Where are we in the tariff world?
Yeah, so he's got about 4 other authorities under 3 laws, and some of these laws date back to 1930. The infamous Smoot-Hawley tariff deal that, supposedly set off the Great Depression. It was actually banks, but anyway. So he's got these long-standing authorities. They've stood the test of time. They've been used 100 times. And these are things like anti-dumping, discrimination against U.S. commerce, national security, which, of course, as you know, is infinitely, extendable. So, for example, today, before the Supreme Court, under national security tariffs, we're blocking Chinese upholstered furniture, which is a national security emergency if ever there was one. So the moral of the story is that he can reimpose all these under these other authorities, and that looks like what he's going to try to do. The numbers that matter for him, when he sort of pitched the tariffs, one of them, there were 2 purposes to the tariffs, and one of them was to get other countries to remove their trade barriers, and then the other was to reshore investment into America. Right? Because if you don't achieve those 2 objectives, then it's just a tax. Right, you're simply taxing. Some of it is being paid by Chinese, some of it is being paid by Americans. It's just a tax. So those were really the 2 pitches. And, we just had new trade numbers come in. The trade deficit for December, which is the most recent number, is about $70 billion. That's about 30% lower than it was for the equivalent month of Biden's last year. So up 30%. But actually, a big chunk of that was gold and silver. So as you know, we've been importing massive quantities of gold and silver. Those show up as imports, but when Americans are upset about imports, or when Donald Trump is upset about imports, he's not worried about importing everybody else's gold, right? This is drinking their milkshake, right? So if you control for that, then the across-the-board first year of Trump's tariffs, the trade deficit went down by about a third, by about $300 billion. So he's going to register that as a win. And then the other one is the factory reshoring. So, Trump likes big numbers. And so he's talked, it was 4 trillion, 9 trillion, 18 trillion. It's, just shy of a gazillion. But at any rate, it does look like we've got trillions of dollars coming in to reshore manufacturing here. Now, a lot of that had been strong-armed by Trump in his trade deals. So he squeezed, I think, $550 billion out of Japan, some similar from Korea, about twice that from Europe, something like 4 times that out of the Middle East. The idea being that these countries would build facilities, they would build factories or, oil export terminals. They would build this infrastructure in the U.S., and in return, Trump would give them a break on tariffs. And the reason he's doing that is because general rule of thumb is $1 trillion of investment is worth about 1 million jobs. Right, so that is a huge deal. Like if it's 4 trillion, the U.S. economy in a normal year only invests about 4 trillion. The vast majority of that is maintaining or replacing worn out infrastructure. If you pour 4 trillion on top of that, never mind 18 trillion, you are generating millions of jobs. That's what Trump promised. He feels like That's why people voted for him, especially blue collars. So in his mind, the tariffs are doing exactly what they were intended. Now, a lot of it's not showing up in the numbers. Like all those factories, so far, it looks like we've only got about 200 billion of them actually logged because factories take a long time, right? So Taiwan Semiconductor, for example, is a big factory out in Arizona. $100 billion are putting into it. That will create, rule of thumb, 100,000, what is that, 100,000 jobs. However, it's about 6 years from blueprint to actually putting somebody on the assembly line. So a lot of that reshoring has not happened yet. But he wants it to continue, and he's probably going to use those other trade authorities. In fact, it took him roughly 3 hours to come out and say that, screw the Supreme Court. He added that their families should be embarrassed about them. And then, he talked about these other trade authorities that he was going to replace them with. So I think tariffs are here to stay. The other thing is that a lot of Europeans or Chinese, they might be looking at the calendar thinking Trump's only got 3 years left in office. But the thing is, Biden kept almost all of Trump's first-term tariffs. Right? So Democrats have loved tariffs since forever. Traditionally, it was Republicans who were fighting tariffs because they were, serving big business but like working regular American voters love tariffs. They're willing to pay more for stuff if it's made in America. The crony companies, of course, absolutely love tariffs because they would love to ban the opposition. So I think, however much bubbly they popped in champagne last week, Trump's going to continue doing the tariffs with other authorities. And even if Trump loses in 2028, Democrats realistically are going to continue them.
And what do you think about this idea? I spoke with the economist Dr. Arthur Laffer, who has said, well, Trump is a free trader at heart. He's using these tariffs as a big stick to get people to the negotiating table. If you look at his track record, he started with this, tariff threat. And by the end of his first term, the tariffs were actually lower on average than when he started with. He made these trade deals, USMC being a big one. Do you think that same plan is happening? We just have Trump amnesia, forgetting that, hey, he said he's going to use tariffs, and then he had lower tariffs by the end of his first term. Do you think the same exact game plan is happening in Trump's second term?
Yeah, he definitely threatens a lot more than he than actually happens. This is the taco trade, so-called Trump always chickens out. He cuts deals. I think that, with a number of countries, he's basically cut deals with them where he dramatically reduced the tariffs in exchange for them allowing in U.S. goods. I don't know that he's a free trader 100% across the board. I think he's closer to Reagan, right? So Ronald Reagan, in general, he was a free trader. He's very skeptical of government in general, which would imply tariffs as well. But Reagan had a lot of tariffs. He focused, at the time, the issue was Japan. So at this point, half of Japanese cars sold in America are made in America, which is not far from what the big three do, because they've, meanwhile, offshored a lot over to Canada and Mexico. So, I think Trump is basically the same playbook as Reagan, which is he's very, very interested in reducing trade barriers. He can be bought with American jobs, right? So if you, ship $1 trillion in the U.S. and create 1 million jobs, he'll look the other way on pretty much everything else. I think that's a good thing, no matter whether you're a free trader or not. You want a president who's, willing to do what it takes to bring jobs into the country. In terms of is he secretly pining for, zero tariff world? I think the jury's out. I think he's probably closer to Reagan.
And last thing on this trade frontier, we've seen, a big trade war threat between the Chinese and the Americans. So far, that has not come to pass. What do you think about this idea that China and the U.S. are kind of interlocked? We're in a stalemate. We're maybe coming towards an amicable divorce. We know it's going to happen, but we don't want to fight in front of the kids, I guess is the analogy. Where do you see this China-U.S. relations? Is this something where our economies are too intertwined to have a full-blown trade war, but each country will work on its own dependence? Or do you think that actually over time there's going to be a split where we say, hey, we know it's harmful for both countries, but we're going to split out in the open in public with a fiery battle?
Yeah, China's a funny economy. So they have pretty much captured manufacturing for the entire world. That is an issue in every country. It's an issue in Europe, in Latin America. It's an issue in Japan. They talk about hollowing out and how the industry is all fled to China. A lot of these countries don't want to manufacture in China, right? China puts a lot of restraints on you. It threatens you. It arrests your CEOs if it doesn't like what your home country does. It forces you to train your competitors, so-called tech transfer. So a lot of countries are kind of looking for an excuse to get out of China. They can't get out because the cost advantage has been so massive. And what has happened over the past really 30 years is that China became so dominant in manufacturing that there's a lot of products where you kind of have to go to China. There was a case a couple of years ago, the city of Akron, Ohio. So they used to be the glass capital of Earth. They were like the Silicon Valley of glass back in the 1900s or something. So they wanted to have this 100-year anniversary of glass, and they wanted to do this giant curved glass wall, which was a process that was invented in Akron. They were unable to find any American company who knows how to do that. They had to buy Chinese. You can be darn sure they did not want to buy Chinese for that kind of a celebration, but they had to. So it's an interesting situation now where no country can divorce China tomorrow because there's a lot of areas where nobody else, frankly, knows how to do it as well as China now. And then you throw in the cost advantage that, not only, like, it's not just a question of China as a poor country that has low wages. No, literally nobody else can do it. Like, there are a lot of fields where Chinese technology is the top of the world, not Japanese, not Korean, Chinese. So you cannot divorce tomorrow. But at the same time, the US and pretty much every country, including Japan, including Europe, are looking for excuses to scale back in China. The decision makers of those are governments. The people who suffer, from not being able to manufacture in China are companies. Those are different people, right? So there's constant tension there where, say, Japanese companies are trying to continue manufacturing in China. They're generally trying to scale it back because they don't want to be so exposed to China, both economically and politically, especially with the trade thing. But it's tricky. They're for the moment, I think everybody in the world, including the US, is stuck dealing with China.
And what about this question about inflation? Obviously, with globalization, we've seen, Chinese products help with the cost of goods, whether it's, toys at Walmart, everything to
Yep.
steel. We've seen kind of a deflationary pressure on prices because of this manufacturing powerhouse in China. If that goes away to some extent, either quickly, sharply, or slowly, what's the inflation story going forward for US investors?
Yeah, it's a fascinating question. I think the way to look at it is that so between, call it 1990 and 2020, we actually inflated. We should have had much higher inflation. It should have been running 4 or 5%. But what happened is China was this amazing technology that could make everything for free. Like toasters are $9. I mean, it's crazy. So China could cancel a lot of that inflation. So that means that if China fell into a hole tomorrow, then those prices would, essentially all of that hidden inflation would come rushing back. So that's part of the trick here, right? If you go to Costco, for example, in the DC area, you can always find a US made version of, say, a coffee maker because US government, organizations are compelled to buy American. So you'll find it. You'll find the $9 Chinese coffee maker. You'll find the luxury $19 coffee maker with the timer and the whole bit. And then you'll find a $72 1970s vintage piece of garbage that was made probably in Akron, Ohio. Okay, that's a world without China at the moment, right? So yes, I think that's absolutely true. Now that's running up against something interesting that's coming here, which is that Kevin Warsh, who's Trump's new nominee for the Fed, he's talked about AI doing that. So he thinks that AI is going to be such a massive cost cutter. To give an example, Goldman Sachs, they had a use case where they put AIs on, I don't remember the specifics of it, but like an IPO, you have to do these massive reports for IPOs. And they put an AI on it and then, had a human check the final output. And they said that it cut their cost by 95%. Right. So if you take 95, that's not China. I mean, that's much bigger than what happened with China. So if that's true, then we get this interesting dynamic where on the one hand, this gradual separation from China could end up driving up costs because you got to make these things in America. They cost 2-3 times more. But on the other hand, you could have AI doing this other thing with all the other costs because the vast majority of costs are cubicles, their service, their white collar jobs is what makes everything expensive in the economy.
And what do you think about this Fed nominee, Kevin Warsh? Obviously, there was some guessing over the machinations of who would be elected. Would Trump elect himself to be, the head of the Fed? And yet, Kevin
It would be
Warsh,
on brand, yeah.
it would be on brand. Yes, he'd have the best rates. So Kevin Warsh is the pick. Where do we see Kevin Warsh? Is he a Trump appointee who is a lackey in the sense that he will do whatever Trump wants? Is he actually independent and saying, no, I'm going to do what's best for the economy as the head of the Fed? Where do you see a Kevin Warsh Fed nominee?
Yeah, he was a big surprise. So the guys that Trump was generally floating were all kind of yes men, easy money, high inflation guys. And at the last minute, he had a guy, I think Rick Ryder or something. This guy, he's got like the shirt unbuttoned to the belly button and the whole thing. And he was like, I mean, he was just a inflation dove from central casting, and he was surging in the prediction markets. And then finally he comes out with this Warsh. So Warsh is by far the tightest guy out of the batch. He's the closest thing to Paul Volcker 2.0 that we've had since the 70s. So he really shocked markets. And, you saw on the announcement, like you could time it to the minute, gold and silver were, runaway soaring straight to the moon, forget Bitcoin. And then all of a sudden they crashed almost to the minute because the market interpreted Warsh as a much tighter money guy. But Warsh is complicated because, all right, so first off, he, back in 2008, like sort of the reason why he's seen as the tight money guy is that in 2008, we had unemployment was running like 8-9%. We had inflation at the time. And Warsh said, no, we got to hike rates. Right now, that's music to the ears of a classical liberal and Austrian economist. That is indeed how you fix a recession, is that you accelerate the purge of the malinvestments. You get rid of all the garbage, and then you restart with a clean slate. But that's really, I think, why the market sees him as a hard money guy. But there's two caveats to that. So one of them is that for about 10 years now, Warsh has been talking about what he calls Robin Hood monetary policy, where the idea is that you cut rates for Main Street, which everybody knows raises inflation because you're printing more money. The banks magic it out of their rear end. However, you cancel that inflation by forcing the Fed to sell the $6.5 trillion of assets that it's got on its books. The way that the Fed bought that was through so-called quantitative easing, where they type a bunch of zeros in the basement. They say this is money, and then they buy everything in sight. All right, so if you sell off that $6.5 trillion, you're effectively canceling $6.5 trillion worth of dollars. Well, there's only about $20 trillion in the U.S. economy, so that's like 30% deflation. All right, so his idea is you cut rates for Main Street. This gets small business growing. It creates jobs. Small businesses create something like 5 to 10 jobs per dollar of revenue compared to big business. So that's really how you make jobs. And then his idea is you pay for the inflation by squeezing Wall Street, right? By selling off all these financial assets that the Fed bought up. So that's one point. So what that means is that in terms of inflation, he may be a hawk, but in terms of interest rates, he looks like a dove. Right. Normally, we think of interest rates and inflation as being the same, basically the same question. Usually they are. But in this case, because of that Robin Hood thing, it's separate. The second one is that AI deflation. So that's actually coming from him. When your Fed chair is saying that you're going to have catastrophic deflation, right, this suggests that however much he liked the Robin Hood thing before, he's going to like it a lot more now. So I think that markets are actually underestimating how sort of dovish he'll be on rates, even if, he like normally you would think that all those activities slashing rates would drive inflation.
If you want our gold price predictions heading into the rest of 2026, this institutional grade research is absolutely free, no credit card required. All you have to do is click the link in the description and we'll send the report directly to your email inbox. At Monetary Metals, you can earn a yield on your gold paid in more ounces of gold through gold leasing and through gold bonds. Instead of paying storage fees to own gold, now your gold is paying you to own it. Your gold can grow and compound, and your ounces actually increase every year rather than decrease every year. This is what it looks like to treat your gold the way central banks treat theirs. Visit the link in the description to learn more about how you can start monetizing your gold today. And Peter, in this kind of Robin Hood scenario where the Fed is cutting rates, there's this kind of Fed rate cut stimulus, but also trying to tamper down inflation by selling off some of these assets. How should investors think about their portfolio? Obviously, low rates are a different type of environment with low inflation. If low rates have high inflation, that's a different environment altogether. How should investors think about assets in their portfolio in a Robin Hood type scenario?
Yeah, it's tricky. In terms of the economy, it's a very good thing. General rule of thumb is every percent of Fed rate cut is also worth about 1 million jobs. So in terms of the economy, if you're a worker, this Robin Hood thing is fantastic. It's trickier if you're an investor because one of the main drivers of stock prices, asset prices, gold, housing, everything. One of the main drivers of that is liquidity that the Fed dumps into the market. And if the Fed is slashing rates, but it's pinching, it's doing QT, quantitative tightening, by selling off all those assets, that is sort of a concentrated, that's like a much more concentrated hit to financial markets than the rate cuts, right? So it's not that he's, giving one and taking back one. I think that the liquidity impact of Robinhood is probably going to be net negative for markets. So it's interesting in terms of specific, again, if you look at the specific reactions to his nomination, growth stocks did get hit on that, right? Suggesting that people are aware that, on net, he's going to be cutting off liquidity to financial markets. And that's kind of the whole point of Robinhood, right? Help Main Street, punish Wall Street. Wall Street, unfortunately, captures many of our retirement portfolios.
And on this guy, Warsh, and his potential nomination, he's only one guy, right? There's other people on this Federal Reserve Board. How important do you think he is going to be? Is he going to be able to strong arm the rest of the board members to go along with his agenda? Or is he going to be a lone wolf shouting from the rooftops, but really not achieving as much as maybe President Trump hopes?
Yeah, we've had funny dynamics in the Fed. So traditionally, the Fed kind of had this gentlemanly, we're all going to agree with each other, and we're going to make it look like we don't have any disagreements. And, you do that to fluff up this image that people have, kind of the Wizard of Oz, that, these are all scientists and they have a consensus. So that's been the traditional routine. And in recent decades, that's broken more and more. So you have more dissent, you have more, sharp disagreements. And so that could bring us towards a Fed that looks more like the Supreme Court, where everybody's sitting there tallying, do we have 5 votes? Do we have 4 votes? And so, Trump is still about 2 votes shy if we get towards that world. That's, I think, part of the Lisa Cook thing. When he was going after Lisa Cook for mortgage fraud, he was, trying to get one more seat on there. But I think that is what we're headed towards. And we saw a similar dynamic in the Supreme Court. So you go back 150 years, the Supreme Court had the same routine. So they would all sort of sit and try to agree on something. They would come to a consensus. You didn't have these real sharp splits. Now you do. I think that's where we're going with the Fed.
I want to ask now, if the Fed does cut rates, of course, that would be helpful in terms of the interest expense on the debt being much lower. Right now, that interest expense on the debt is even higher than we're spending on the military. But in a way, does that allow someone like a President Trump and the administration to put even more onto the debt, knowing, hey, this interest expense is no longer an issue? Where do you think about the debt question in a world of lower rates?
Unfortunately, it does. He recently floated that he wanted to bump the military budget to $1.5 trillion, which we spend like more than everybody else in the world. These are insane numbers. But at any rate, by instinct, I think Trump likes cutting spending. In his first term, every single budget that he came up with, he had big cuts, like 70 or 100 billion, which is a lot of money back then. And every single time, Congress, of course, said no. I think that when it comes to military, the border, right, there are a couple of issues where he really doesn't care how much money it's going to take. And then Congress, of course, and everything else doesn't care how much money it's going to take. I think we're sort of, in terms of the debt and, talking about the long-term trajectory of the debt and the deficit, I think we're sort of in a dangerous place because we just came out of a natural experiment where we had the perfect storm, right? Small government Republicans, alleged, controlled every branch in Washington. You had Elon with Doge, which all the Republicans swore up and down that they supported. Obviously, that was driving the base. I mean, you could probably see, but MAGA was the most energized in this second term when Doge was in the headlines. Maybe the second was the Somali Leering Centers. The moral of the story being they desperately want to slash government. They don't want to cut it. They don't want to trim it. They want to slash it like a third, a half, 3/4. And then, of course, you had Trump, who from his first term had been, he was generally the guy who was trying to cut the spending. He's obviously hostile to the federal government in general. He's skeptical of the value of government spending. So you had the perfect storm, right? You had all the pieces clicked into place and nothing happened, right? What we got out of that was that in Biden's last year, federal spending grew about 11%. This past year, it grew about 2%. Okay, so the absolute perfect storm, right? Trump was talking about getting rid of the income tax during we'd never seen anything like this. Never before. And boom, right? It took us from 11% to 2%. Could not cut a dime. So I think the takeaway there is that it is impossible to cut federal spending. Won't happen. We just tried. We had everything, all the stars aligned at once. Mars was in, retrograde, and it ain't going to happen. What the administration has now pivoted to, like Secretary Bessent, is focusing on growth. Right? So the idea being, all right, give up on spending. You have to accept reality. We're not going to cut spending. And so instead, we got to grow the economy so that we can grow out of the debt. Now, if you're spending an additional 2% every year, you've got the deficit going on top, which I think is growing at about 3% roughly. In other words, the debt gets about 3% bigger every year. If your economy is growing at 4%, then the debt is going to shrink over time. That's what they've gone to. Now, in a sense, you could say that's kind of a pathetic booby prize. Like, y'all gave up, and so now, well, okay, next best. But the other side of it is that it's healthy in the sense that we should be focused on growing the economy more, right? We should have a consensus in Washington. Government spending, yes, they're parasites. Yes, it's corrupt. Okay, but the big picture here is that if you can grow the economy, so in other words, if I could shrink federal spending by 500 billion versus growing the economy by 10 trillion, I'm going to take that one. So I think it's healthy that they're focusing on that, which kind of brings us back to the trade thing, because when we talk about tariffs and reshoring, we wouldn't need any of those if we had a better business environment in the US. Like when I look at manufacturers, you have some like machine tool manufacturer in, Kenosha, Wisconsin. You have got to be a masochist, man. Can you imagine all of the paperwork, the regulations you got to put up with, the lawsuits, that just endless? EPA wakes up tomorrow morning and, there's some shrimp that lives in a puddle 5 miles down. And I don't understand why people manufacture things in the U.S. So you want to change that, right? You want to, wipe out those regulations, reset us to, let's say, 1950s regulations. It doesn't have to be Mad Max, but, if you just went back to 1950s, you get rid of like 90% of the regulations. I'd like to get rid of income tax, certainly on small business, to encourage people to, switch from, sort of wage slaves to starting a business. If you did those things, right, if it was zero income tax to start a business in the U.S., and if regulations were slashed 90%, then we wouldn't need tariffs. I mean, the Chinese would be moving here anyway. The Europeans certainly would be moving here anyway.
And what do you think in terms of not just what we would like, but actual likelihood of major changes going forward in the economy? Do you think that basically Trump in his first 100 days did the things that he's going to do, and this is basically what we're going to see? We're going to see Democrats take over parts of the government in the midterms, stalling President Trump's progress? Yeah. Or does he have more kind of tricks up his sleeve?
Yeah, normally you would say that. So Democrats' odds of winning the midterms about 80% at the moment. Historically, 90% of the time, the out party wins. So that's not shocking. That's pretty much how the game works. And in theory, that would slow Trump's agenda, because at that point, he wouldn't be able to get anything through Congress. But the thing is, he's gotten almost nothing through Congress anyway. Right? Almost everything that he's doing is executive order. And, this is part of the whole death of democracy. What is it? Democracy dies in darkness, because they're all pissed off about the EOs. But fundamentally, almost everything Trump is doing is EO. And, what he seems to do is he's got a bunch of people who have their ears out, and they listen to, frankly, people like you or I, people on Twitter. They listen for, things like banning institutional purchase of single family homes. They listen for these things, and then they adopt them. So honestly, I think he'll just continue doing that. I think, he'll continue going after regulation. They just got rid of the, CO2 endangerment, which is a massive global warming regulation that, I think that was NEO where he went through that. But I mean, essentially everything outside of the big, beautiful bill has been EO. I think he's going to continue that. He'll continue, honestly, just looking for ideas wherever he can, sticking them in, and then daring the Supreme Court to strike them down.
All right, Peter, before we get to the rapid fire section, what are some ideas? We have a President Trump listening, or maybe one of his administration, and they say, wow, this guy Ben's really smart. This guy Peter's quite good looking. Let's hear what they have to say. They can give us some ideas on how to increase economic growth, make the country better. Peter St. Onge, what are your ideas?
All right, for growth, it's easy. You got to do something about taxes and regulations. On regulations specifically, you got to fix the global warming garbage. There's a lot of labor regulations that gunk it up. Basically, you want it. And then, you have just general red tape on starting a business. You want it to be as easy to start a business or hire a person as it is to order something on like Uber Eats. Okay, you want this to be super frictionless, super easy. And all right, so that's on the growth side. If you just kind of paint a picture here, if you slash regulations to 1950s level, you would something like double the economy. In other words, take home family pay would go from 80,000 today to like 160 as a very big deal. And this is based on Mercatus. Cato has done studies on this. They're just absolutely massive numbers that are absorbed by paperwork. Paperwork accounts for something like 1 in 5 business minutes is farting around with government paperwork. Same deal with the income tax. If you had no income tax whatsoever, general rule of thumb on the income tax, this is actually from a paper published by one of Obama's chief economists, Christine Romer. Every dollar collected in income tax destroys $2 to $3 of economic output because it dissuades, like if you're facing a 50% tax rate, you're not going to work as much, right? You're not going to take risks on your business. You're not going to try to expand it because if it doesn't work out, government's not footing the bill. If it does work out, they're going to take half. So you put those two together and regulations, income, getting rid of the income tax altogether, ideally, those two things together, you would literally triple the economy. Household family income would be $250,000. A lot of these problems wouldn't exist anymore. No, All right, so that's on the growth side. On the expense side, the big ones for Americans are, of course, healthcare, housing, energy, and food. And on energy and food, he's doing pretty good. A lot of it, again, has to do with regulations and energy. A lot of that's permitting. It's also global warming stuff. In food, a lot of that is regulations on farms. And absolutely, they're focused on those because Trump sees those as his people. He sees farmers as people. In terms of, housing, he's been, like every week he's got a new EO on it. So, he's got he had the 50-year mortgages. He wanted to sell off federal land. It's just an endless stream. He had Fannie Mae buy $200 billion in bonds, which lowers mortgage rates. So he's been just nonstop on housing. He's trying everything. Congress actually has a bill that they're currently debating on housing. I got a video coming out on it where they are hitting all the right notes. So, they're talking about deregulation, about small dollar mortgages, which banks typically neglect, but those are important for young families. So they are hitting the right notes on housing. And then healthcare. So, again, Trump's been trying his EOs. Congress has characteristically done absolutely nothing. Is specifically what he's got the most favored nation where, pharma makes all their profit in the US and then they give it away to Canada and their socialized medicine. And so he says enough of that, you got to charge us the same price. So he's trying to tweak what he can at the edges. He's also talked about sending dollars to individuals instead of insurance companies. But really, the big lifting has to happen from Congress. Fundamentally, what you need to do in healthcare is that the way that our current system works, it's like if you bought car insurance that included the gasoline, right? And every dollar that you insure costs twice as much because you got this army of people have to, you got the paperwork and the compliance and so that would be a dumb way to do it, right? The way that you do with the car is you only insure things that you cannot handle, right? So in other words, you don't insure doctor's visits, you don't insure the 80% of healthcare dollars that go for routine stuff, you just pay it out of pocket. And in terms of catastrophic stuff, even there's got to be some kind of cost sharing. Like in Singapore, for example, if you go into a public hospital, the government's going to cover 80% of it. But if you want a private room, the government coverage drops to like 20%. The idea being, if you're rich, you can handle it, right? If you're not rich, you still have to have skin in the game because today, like for example, pharmacy costs for a prescription, they can be 2 to 3 times different. Like from different Walmarts in the same city, it can be 2 to 3 times different. I didn't know that. I don't think most people know that because who cares, right? Your insurance company is paying. Hospitals, right? Again, you can have a 10x difference between, going to the mini ER or going to the emergency room, but you don't care because you're not actually paying for it. So hospitals have lobbied for this system where you have full coverage. It sounds grand, but what that means is that the customer, the person who's deciding where to go does not care what it costs. So you have to have some kind of skin in the game. It's going to be 5%. It's got to be something in there in order for customers to care. So of course, is that going to happen? No, because there's so much money, right? You take the lobbying money of pharma, insurers, hospital agencies, the AMA, those lobbying dollars outweigh Wall Street. So realistically, the only way that's going to happen is executive orders because Trump is very hostile to the to the health industry in general. He blames them for mucking around with the vaccine timing, waiting until after the election. There's a lot of bad blood under that bridge. So I think Trump, in terms of EOs, I can absolutely see him doing a lot of those things. Some of them, of course, are tricky, right? If you try to convince voters to, pay 5% of their, hip replacement, they're not going to be thrilled about that. But those are fundamentally the ways that you reduce costs. And, I would put the odds of Congress doing that voluntarily at roughly zero.
Peter, before we get to gold, I want to do a rapid fire section with you where we'll hit topics from all over the map. You can answer as short or as long as you'd like. Let's start with the idea of modern monetary theory. This was obviously quite big back in the day when COVID happened and inflation struck. Most people thought, maybe this idea is not so good. Where does modern monetary theory stand in your eyes? Is the idea dead, or is it just waiting for another comeback?
I think it is 100% waiting for a comeback. It's like locusts. They never actually die. They just wait until the timing is right and come out again. Inflationism has been a thing for a very long time. And the fundamental problem with inflation is that you can print money today and it doesn't show up in prices for a while, right? There's a variety of reasons, the Cantillon effect, where it's being distributed to the rich people, the rich get richer. There's a bunch of reasons for that, but typically there's a delay. It could be 12, 18 months, could be longer, depending on whether people save it or not. And so I think Deirdre McCloskey has a metaphor where, it's like drinking radiator fluid. It tastes very good. I highly recommend it as a cocktail, but you shouldn't do it, right? And so this is inflation in general. The idea, and when MMT was booming during COVID, it was booming before Bidenflation. Right? Once, and they were saying, oh my God, it's a free lunch. Look, we printed all this money and prices are still going down. Well, yeah, because it takes time for it to transmit. And then once you got Bidenflation, they all, found something else to occupy their time. So sadly, it will always be back. It's a permanent fixture. It's the job of people who know economics to, warn everybody that this is radiator fluid.
Next one for you. Let's talk about AI briefly. Obviously, there's some claims AI is a big bubble. None of these companies are making any money. They're all subsidizing crazy losses. The CapEx just doesn't make sense on paper. There's no cash flow. And on the other side, you have these 95% efficiency gains. People are coding, creating new, genetic variations that have never been done before. Where is AI? Is it both a bubble and not a bubble at the same time? Where's the AI story to Peter St. Onge?
Yeah, so I think AI is .com on steroids. Depending on the metric, it's twice .com or 10 times .com. If you look at the dominance in venture capital, for example, I think .com is at its peak was something like a quarter of venture capital. It was biotech and materials and all kinds of things. AI is like 80%. I mean, it's insane how dominant it is. It is much, much bigger than .com. And if you look at the money going into it, the sort of crazy money going into .com was fiber optic. I think by all accounts, looking back in hindsight, nobody thinks that Amazon.com spent too much on its website. Okay. The concern for .com was specifically fiber, and fiber got overbuilt, and then it was dark for like 10 years, and it took time for it to fill in. But even so, if you look at the quantities involved as a percent of GDP, AI is something like 10 times bigger. It is absolutely massive. And like .com, early on, so you can go back to 1995, 1997. You can find all these articles talking about how nobody has figured out any way to make money on the internet. So there's an article that complained that Yahoo shouldn't be worth anything because the basic business plan is like you build a space in Manhattan and people walk in and look at ads and you give them a glass of water while they watch the ads. And, this is goofy. Like, what's the business here? And, of course, Yahoo begat Google. I mean, it got competed out by Google, but Google is worth how many trillions? So, the .com, if you look at the fiber, it obviously overbuilt. If you look at, valuations of Amazon or Google circa 1998, which was kind of the peak of people complaining about the .com bubble, they were too low. They were way too low, right? Because if you look at what they are today, they're much, much higher than that. The CAGR was astronomical between the bubble period and what they are today. And so the question is AI, is it internet content, where even during the height of the bubble, it was still undervalued, or is it pipes? And the question there is, what can AI do? So, there was a recent report, I think it was, I want to say it was Microsoft, but anyway, it found that something like 95% of AI projects don't turn a profit. Okay, but again, going back to 1997, there was an article that was talking about how it was complaining that and this is like in CNBC, how CEOs are all talking about their internet strategy, but nobody's actually making money on it. So this is just fashion, so CEOs can look like they're with it. Okay, so in retrospect, right, like the idea that your business didn't really need the internet. This is goofy to have a website. It's dumb, right? Because early on, most internet projects didn't make money because they weren't integrated into the business yet. AI, the early projects right now are generally pilots. So, they're certainly not making money, but those are going to be integrated. That takes time. And that then leads us to the question of, one of the biggest concerns on AI is jobs. And in the numbers, AI has not shown up in jobs yet. The closest that you've come to is, for example, Amazon talked about how it was planning to hire 600,000 people in future, and it's no longer planning to do that because it's automating its factories. So there are some areas where it's showing up, but in terms of like layoffs, job losses, it's really not showing up very much in the numbers. And this is contra predictions. You can go back 5, 8 years ago, and there were these predictions from outfits like Gardner that by now we were supposed to lose like 30 or 70 million jobs, just goofy numbers. So the AI jobs thing is overhyped. AI installation, I think it's gone slower than people expected. And the main reason is the hallucinations. Right. So I don't think even AI engineers expected that degree of hallucination where AI just confidently makes stuff up because it wants to make you happy. At one point, a couple of years ago, those were running about 50% hallucination rate. That's now down below 1%. You have to be a lot lower than that in order to actually use AI for customer service. So it doesn't, promise, a free Lamborghini to your customer. You need that to be close to zero, but AI is getting very close technically to the point where it can be mass deployed. At that point, I think the profitability on it will absolutely skyrocket. I mentioned earlier the Goldman study, 95% cost reduction in entry-level finance work. You're going to see that in IT, body shops, these sort of Indian low-end outfits. They're, going to be looking at 95% cost reductions. You're seeing sort of industry by industry, right? There was a couple weeks ago a video of, I think it's Tom Cruise was having a fight with,
Joe
talking
Rogan.
about, right?
Yeah.
Yeah, they were like having a fist fight, and people were, were like, "Wow, AI is capable of AI quality movies," and so that sort of created the scare in Hollywood that actors don't have any value anymore. I think you're going to keep seeing that where specific industries are going to be shocked. Sort of the AI displacement trade. Just last week, there was a blog post. Somebody had showed that Claude AI is good at COBOL programming, and that hit IBM stock for 12%, which is like $30 billion. I think that you're going to continue to see individual sort of labor niches and individual companies getting hit by AI commoditization. But yeah, I mean, in terms of big picture, if you go back to the dot-com era, everybody lost money on the internet in the very beginning. That's how it works. Give it a couple of years, and I think it's going to start turning massive profits.
All right, last in the rapid fire section, let's talk about gold versus silver in 2025 before we do a deeper dive on the precious metals. Where do you think is going to outperform, gold or silver? Obviously, gold and silver had massive banner years in 2025, starting 2026 as well. Where do you see the gold and silver picture going forward into 2026?
Yeah, so silver in general, of course, it tends to do whatever gold does, but do more of it, right? So it's like a gold on steroids. So if gold goes up, then I would confidently predict that silver will go up more. If gold goes down, silver will go down more. But having said, there's this big extra boost that silver is getting right now because it is a key input into AI data centers, EVs, solar, robots, okay? Because when you have high value electronics, you want to use the absolute best conductor, which happens to be silver. It's non-corrosive. It is the best conductor. When you're dealing with, $7 toys, you can put other substitutes in there, but you need silver for these things. They're so high dollar. Like a single chip from NVIDIA, I think is like $14,000 or something. You're not going to skimp, using cheap metals. So there's tremendous demand for silver right now. I think that's really what's driven it. But you've seen backwardation over the past couple of months in both gold and silver. And that's something that used to happen like once a generation, right? And this has happened multiple times, and it's happened with gold as well. So it's not just the AI trade pumping silver. I think there is a huge, fundamentally, I think what happened there is the debasement trade with that natural experiment where When Doge failed, when unified Republican control failed, a lot of bond investors concluded that, there is no hope at this point. The train is going off the cliff. So they had such parabolic runs that it would not be shocking if they ended the year flat or down from here. But I think that the long-term trend on both of them is up. I think particularly in silver with those industrial applications.
In our 2026 Gold Outlook report, we discuss, of course, the currency competition between the US dollar and other currencies, and of course, the monetary competition, gold and silver versus cryptos, and of course, the US dollar. So, where do you see this currency competition? Do you still see the dollar as the king of the currencies and gold and silver as the king of the monies? Where do you see this competition between currencies versus money?
Yeah, I think that captures it. The dollar has recently actually gained share against other currencies. As bad as the dollar is, the thing is you want to keep in mind how bad everything else is, right? So if you look at the euro, the EU is dysfunctional in many, many ways that we can't even imagine. Japan, of course, is a crap show. Even China's rough. China's added more debt than we have. So they're essentially, to the extent they're growing, which they're not growing very fast, they're about 5%, which is not big in China. That's about half what they used to grow, and even that is being bought. So if you look, and then every other currency like Switzerland, may keep its house, cleaned, but it's only so big. Plus, the Swiss government has illustrated that they do not want to be a reserve currency. Right during the European crisis back in 2012, a lot of people started selling euros and piling into the Swiss franc, and the Swiss government just dumped I think it was like 280 billion, which is a huge amount for Switzerland. It's the size of Kentucky. So they dumped all this money out to try to counter that and to weaken the Swiss franc. So you really don't have any other currency havens, which means that it's down to gold, silver, to a certain extent, Bitcoin, although Bitcoin has gone absolutely nowhere in the past year, which is kind of fascinating because, for years and years, Bitcoin tracked gold and silver. But in this past stretch here, Bitcoin has collapsed down 50% while gold and silver have soared. But yeah, so I think the dollar essentially, if you sort of zoom out here, it's about the monetary competition. So gold and silver are, crowding in. They're grabbing market share from paper currencies. We just saw recently that central banks now hold more gold than they hold US dollars. I think eventually they're going to be holding more gold than they hold all paper currencies. So I think that, and then in terms of the sort of currency competition between paper currencies, I think honestly, as the end comes close, I think the US dollar actually gets stronger, that it gobbles up the corpses of weaker currencies on the way down because these other guys go down first. They don't have the depth, they don't have the liquidity benefits that the US dollar has for like the New Zealand dollar.
And where do you see this stable coin question here? Because a lot of people have said these stable coins have given a second life to the US dollar. There's now more demand for US treasuries in this form of stable coins. This Genius Act, of course, helped banks keep their share of the pie while letting stable coins join in on the treasury fund. Where do you see the stable coin question going forward?
Yeah, the Genius Act was actually interesting. The banks are really upset now because what the stablecoin issuers are doing is sort of giving little side benefits. Like, all right, so specifically, the Genius Act allowed stablecoins to function like a bank account. And banks hate that because stablecoins have to be backed, right? Whereas banks don't, right? You have fractional reserve. And so banks are afraid that they'll lose deposits to stablecoins. And so banks inserted this clause in there saying that stablecoins could not pay interest. But then the stablecoin issuers are finding all these creative ways to pay interest. And so they are taking stuff away from the banks. That's setting up this kind of boss battle where you've got the deep-pocketed stablecoin lobby against the very deep-pocketed Wall Street lobby. They're kind of having a fight in the background. Of course, I'm rooting for the stablecoins because they're not fractional reserve. So if Wall Street would like to convert itself into full reserve banking, then I can get behind them. But for the moment, in terms of the US dollar, stable coins mildly boost the dollar because you have to back a stable coin. Generally, they're backed with bonds, which is helpful for the treasury market. It's also helpful for dollars. But in terms of like incremental demand on the US dollar, I mean, it's a very small amount. If they're taking share from traditional banks, those traditional banks are banked even more by dollars because they're fractional reserve. So I don't see it having a big impact on the dollar. At best, it stops a process that was already occurring where US dollar demand was drifting off into stable coins, which may or may not have been backed, right? That was part of the Genius Act, was to put backing on stable coins so that they don't collapse, which makes everybody embarrassed in the regulatory world. So yeah, I think stable coins are going to keep growing. I'm very interested in the resolution of that boss battle with Wall Street to see who wins that one. And the best you could say is they stopped the US dollar from dying earlier.
Peter, I want to end here on gold. Obviously, we've discussed some of the perfect storm dynamics for gold when it comes to debt, of course, some of the fiscal issues as well. There's also upgrades to gold at Monetary Metals. We pay a yield on gold paid in gold. There's now tokenized gold projects. There's yield-bearing tokenized gold projects. Where do you see the bullish narrative for gold going forward? And what is the bearish case for gold going forward?
So the bullish case is government deficits continue to be out of control, which is almost guaranteed. That got interrupted by Warsh because he was not as dovish as people expected. The bearish case for gold is exactly that. And there's two ways that government deficits could get under control. So one of them is that you could have responsible leadership, which sounds ridiculous, but we did have it in 1990s. It actually involved gridlock where Newt Gingrich and Bill Clinton hated each other. They couldn't make any deal, and so they sort of deadlocked. Countries like Canada have had periods again in the 1990s where Canada substantially cut the deficit. It is possible. I think given what we just saw, it's almost certainly not going to happen. But if government suddenly woke up and started getting fiscally responsible, then that would, take gold down a notch. Now, historically, that only happens in a crisis. And a crisis, of course, would drive gold up, right? So, you could see sort of an up-down dynamic where we have a financial crisis somewhere. When we look back to 2008, that's initially going to hit gold because in a financial crisis, everybody sells everything and people mentally anchor to the dollar, right? So they'll get rid of their, AI options, but they'll also get rid of gold. They shouldn't, but that's just the psychology of it. And then like in 2008, we would see gold soar because the modern response to any sort of crisis is to ratchet up the deficits. If you look at the deficit trend since 1970, when Nixon broke the gold standard or finished off the gold standard, every single crisis ratchets up the deficit. So it doubles and then it goes back, it generally goes back about half of what it went up, right? So, 100 becomes 200, goes to 150, 300, 250, and so on. So if we do have a crisis, then that actually, I think, accelerate. Near term, it could hit gold, but I think that actually accelerates the gold run. The only way that gold in the long run, I think, comes down is if governments across the world get fiscal sanity, which I think is almost certainly not going to happen. The benefits are too high, right? The fact that you can print the money today, you can buy the votes today, and you don't get the inflation until tomorrow, that's insurmountable. It's a fundamental flaw. I think that's why you ultimately need a hard money standard.
Peter, what is a hidden risk that you think maybe investors aren't paying attention to? Obviously, we look at the debt, we look at the Federal Reserve, we look at inflation, but what's a hidden risk that maybe most investors aren't thinking about? Is it fertility? Is it demographics? Is it AI? Is it something else entirely? What's the hidden risk to Peter St. Onge?
I mean, most of the risks, helpfully, are front and center. So Congress could do something stupid, which they will. Governments could spend more, which they will. So most of the risks, I think, are front and center. A lot of these longer term issues, I think, generally trend towards the positive. Like if we take the fertility issue, for example, that people aren't having as many kids, I think that we're actually at the nadir right now. I think things are going to get better in the future. For me, this may sound stupid, but I think that because of AI, I think that we're coming much closer to what's called actuarial escape velocity, where human lifespans get dramatically longer. And this may sound dumb, but keep in mind, Japan right now has average lifespans in the mid 80s. That was science fiction when I was a kid, right? For the average person to be alive in their 80s. I think that, we could be looking at that kind of thing. If we are, then it kind of flips the demographic thing. Because at that point, you're not having as many kids, but people stop dying. And people dying is extraordinarily expensive, right? When somebody dies, they take all that human capital with them. I mean, of course, it's a human tragedy, but as an economist, all of that capital, all those things they know, all that education, all that experience, they take all that with them. So if we move towards an economy where people have average lifespans of 90 or 100 or 120, that is a tremendous, I mean, trillions per year. That would roughly double our rate of wealth growth. It wouldn't necessarily be counted GDP, but in wealth growth. So I'm looking forward to that. I think also with AI, I think people, there's a tendency to love the scary story, but I think the closest analog to AI, okay, first of all, AI could be a joke and it could come out to nothing, in which case, fine, false alarm, go back to what you were doing before. But if AI does what, sort of the doomsayers say, it replaces 95% of jobs and it cuts prices to zero. Okay, if that happens, we have a perfect analog of that, which is the Industrial Revolution. And what happened in the Industrial Revolution is that essentially it's an escalator. The automation is an escalator, but you got to take one step down every 10 years or so, which, by the way, Americans already change careers about every 10 years or so. I've changed careers like 5 times. But anyway, so if you look back to the Industrial Revolution, what happened was you had a great job baling hay on a farm, and then a tractor came along and stole your job. All right, so what you had to do was take the next best thing, which was some service job, right? Working at a store, sweeping out the store or something. Okay, so you had no longer was your physical, hard, strong labor. That was devalued. You had to take the next best thing, which was a service job. But lo and behold, the tractors and the rest of the Industrial Revolution were so efficient that a service job pays 20 times more than it did baling hay. I think what's going to happen with AI here is that it's going to be an almost mirror image where, like the Industrial Revolution, 90% of jobs were either in farming or then later they were in manufacturing, and those were replacing the Industrial Revolution. What we're going to do now is the 75 or 80% of jobs that are service jobs, specifically cubicle, white-collar jobs, those are going to be obliterated, and we're going to bounce back. So we're going to go into service jobs, right? So being a personal trainer, being a pet groomer, being a therapist, a teacher, a babysitter. Okay, we're going to move into either service jobs, we're going to move into trades jobs because robots are going to be much, much slower than AI. The reason is that you need one AI for 8 billion people, but you need 5 robots for every McDonald's. So robots go much, like 30 years slower. All right, so I think in the near term, people are no longer going to work in cubicles. They're going to be bartenders, they're going to be service workers, they are going to be trades workers, they're going to be creators. Right, so they're going to make videos on YouTube. They're going to make handmade furniture. Right, consider that today handmade products are worth a lot more than machine-made, even though you make more mistakes. Right, you make the machine perfect. It doesn't make mistakes. If you hand make a chair, you have like 20 little flaws in there. If you made the chair, it's there. Nobody else knows. But they're worth like 5, 10, a lot more. There was a guy who was making steampunk keyboards, custom-made steampunk keyboard. He was charging $1,500 for that. Could you make that in a Chinese factory for $7? Absolutely. He was charging $1,500. That's the future. So excuse me, I think it's basically the movie Office Space, right? Where people are working in soul-crushing cubicle jobs. Most people don't understand how bad their jobs are. Most people hate their jobs. That shouldn't be, we shouldn't accept that. We shouldn't want that, right? In the movie, he quits his job and he goes out and digs ditches, right? And he's standing there in the sun and enjoying, and he's breathing the outdoors. I think that's what happens, that jobs, the cubicle jobs, if AI turns out the way that they say, cubicle jobs are going to be wiped out. And instead, we're going to have much more human jobs. These are going to be service jobs. They're going to be the trades, and they're going to be creation, either creating physical things, creating, digital content. Already today, you see, audiences hate AI slop, right? There is a massive value that consumers attach to something being created by a human, whether it's a babysitter, whether it's a teacher. So I think that's fundamentally what happens. The automation itself provides the dollars. That's what makes us rich. It increases quality of life and the humanness, right? The future jobs are going to be more human jobs. At the end of this process, 30, 40 years, people are going to look back as they go in for their personal chef job where they, create new things today that people have never tried before. And they're going to be amazed that people actually cared about these horrible cubicle jobs that people are locked in.
Well, Peter, when you go back to being a bartender, I'll be your bar back for sure.
That's the subtext is really what I want. I want to go back to being a bartender. It was my favorite job, man. A fantastic way to waste your 20s.
Peter, final question for you. What's a question I should be asking all future guests of the Gold Exchange podcast?
Ask them about the bartender thing. Yeah, I think it's important for analysts, the kind of people that you interview are generally people who have big picture, they have a lot of historical knowledge, they can kind of see the big trends. And I think that's fascinating for people listening. I know when I'm listening to a podcast, I really want to know, like, where does this fit? Right? Like, not just reporting like news, like, yesterday this happened and, what, where, when, but like, where does this fit in the bigger picture? What are the trends going on here? What can people expect?
Peter, I'm sure people are going to love this episode. If they have arguments, they can fight us in the comments. Peter, where can people find more Peter St. Onge?
I put out daily videos, little 3.5-minute videos on X, the artist formerly known as Twitter. So Prof. St. Onge, PROF STONGE. And then I also do a daily newsletter where I go in depth on something deeper.
For those looking to get the 2026 Gold Outlook Report, they can get that in the link in the description. Peter, thanks so much.
Thanks for having me on, Ben.